Welcome to the daily update, where I'll go over the action in the market for Thursday, March 14th, and then we'll see how things look for Friday, March 15th. As feared, the economic reports didn't really make things much clearer. We had the PPI, which came in stronger than expected. We had retail sales, which came in weaker than expected, but up from the previous reading, and that's causing the market to rethink, okay, maybe the Fed's going to be a little longer now with being able to cut interest rates, if they even cut them at all. So we're seeing economic reports not really helping the market right now. We're still looking quite positive overall, but we did see a decline on Thursday, and we're seeing some weakness start to come into the market that we want to keep an eye on. So let's go back and talk about what happened. Right at the open, we did have a higher open. I think the futures right before we open, it's like, okay, we're going to go up no matter what the news is. And that's how the market ended up opening. We were above the daily pivot at 51.65. Then quickly, very quickly, we fell down below the daily pivot. We got down below S1 at 51.52. We found support at S2 at 51.38. Then things really started to chop around. Prices tried to go back above S1, but chopped lower back down to S2. Then we tried again to get back up to S1 and fell back down again to S2. We found support at 51.25 before rising back up above S2 to close just a little bit under S1. So quite a choppy day. We were down 0.29%, not a real big percentage move. What we're seeing is more under the surface. There's still some strength under the surface, but some other areas that we just want to really watch. This is something that's been different. We've been seeing up and down days on a below average in volume. We saw a down day that was more decidedly negative on above average volume. And we are still positive with our technicals. The market's getting a little more confused about inflation and now interest rates. With the economic reports that came out, we saw, especially the 10-year yield going back up and all the interest rates. We're still inverted with our yield curves, but with interest rates going up, now the market's saying, maybe we better pay attention to this after all. Some comments. There was more of a broad-based decline, and small caps did even worse. Rising interest rates are starting to cause some concerns in the market. We're going up quite a bit now. The PPI was hotter than expected, and retail sales were weaker than expected, so it was more of a gray area. We didn't see real uniformity in this, and there were some other reports that came out that I'll show you later on. We've worked off a few things of our short-term extreme positive or overbought list, but the CCI 14 and 20, they're just coming down after giving us extreme readings, and really the only thing still extreme are the stochastics, the oscillators, and we're just still getting very high readings. They really haven't moved all that much. We have the bullish percent index, which is still extreme positive, but now starting to come down. The Sean trend meter starting to come down, but still extreme. And then we're still camped out really high with that 10-period new high, new low study for the S&P. And we're still looking extreme positive with our 150 and 200 period moving averages. The exponential one has now dropped off of the list. And this is the scenario. We think maybe the Fed is done raising rates. And of course, when we see a strong report like PPI was that caught the market off guard, and we could have tanked a lot worse than what we did, you now start to see, maybe the Fed needs to come in and actually raise rates. And if we start to see stronger than expected economic reports, there may be more talk about that. Right now, it sounds like foolishness, but sometimes what starts as foolishness ends up being wisdom. We'll just have to watch it day by day. The dollar was up. That put pressure on stocks, and interest rates were also up. We're at 4.3% now. So that is causing quite some concern now, where a couple of weeks back, we were rising with interest rates, and the market's like, we don't really care about that. See, the market can pick and choose different things. It's like a buffet of what it wants to be worried about. We're still inverted with our yield curves, and this is strange that maybe the reading that I had in yesterday's video was erroneous. I had us at 67, I believe it was, and I look at today's chart and it said yesterday it came in at 73, and then we closed today at 73. So we're positive nonetheless, and we're coming down off of that 75 level. Our trend is still positive, though. The green line is on top, but we're falling a little bit more under the moving average with the down day. Our bias is negative. We've had 2 down days now, and the momentum I've changed back over to mixed. Here's the economic reports. PPI came in double what they had expected. It came in up 0.6%. They expected it to be up 0.3%, as it was last time. There's the one that kind of freaked out the market too. This is core PPI. This is taking a measure of inflation. It was up 0.3%. They expected it to come in up 0.2%. Last time it was up 0.5%. Retail sales were weaker than expected, coming in up 0.6% last time, or they expected 0.7%. Last time it was down 1.1%. If you take out autos, it was still less than expected, coming in up 0.3%. Last time it was up 0.5%. They had expected it to be up 0.5%. Last time it was down 0.8%. And weekly jobless claims, they're coming in weaker than expected as well. 209,000. They expected 218,000. Last time we saw 210,000. Continuing claims at 1.811 million. Next, we revised this number down. It was in the 1.8s last time. Now, the last number that we got was 1.794 million. Business inventories were unchanged. They expected them to be up 0.3%, just as they were last time. Okay, here's some charts. Here's the weekly jobless claims, and the moving average is going down and the line is going down. That's showing strength. Not a lot of people are filing for first-time unemployment benefits right now, and that's showing strength in the employment area. But we're starting to go back up with the continuing claims, but our 4-week moving average is still continuing to go down, also showing a lessening of this number. And we look at this all together, including the unemployment rate. This is a big chart that might be kind of hard to see. So the next chart, I've tried to break it down a little bit. And the unemployment rate, we only get that once a month. That's why there's a lag right here. It went up to 3.9%. With the initial claims, we're going down, and we're starting to turn back up slightly with the continuing claims. But as I said, the moving average is still going lower. Here is the final PPI year over year. We're starting to go back up with the blue line. That's the total reading, and the core is starting to go back up. And the market wasn't really anticipating that. This is producer price index. These are what it costs companies to make things. And if it costs them more, it's going to be eventually passed on to us as the consumers and possibly be reflected in the CPI. Here's final demand on a year-over-year basis, where it's going up with goods, and it's also going up, but not as much when we look at services. Intermediate goods year-over-year going up with the non-processed goods, and also going up with the processed goods. So this was a stronger report. Here's our rate of change charts. We're going back up when we look at the year-over-year measurements, and we're also going back up on the month-over-month measurement. Here's the core. It flattened out when we look at the year-over-year change, and is actually declining a little bit when we look at the 1-month rate of change. So the core retail sales then, year-over-year basis, they're still above zero and did tick up after they had been declining. And then here's the month-over-month look. Where we were down the previous month, we were up in the reading that we just received. Business inventories pretty much unchanged and not really growing bigger or smaller. Then a couple of charts from Isabel Net. This is just showing the valuation ranges across all the different regions. We have the US over here on the left, and this is the range that normally we would be in, or on a mathematical basis, we should be here, where we're clear up at 21.3. We probably dropped a little bit since then. We are above 20. That's kind of the takeaway there. And then you have the other ranges spread throughout the world, and they're especially in Europe and the Asia Pacific and emerging markets. They're more in their range, where you have these different world indexes, and Japan's kind of at the high end here. So even on a global basis, in some of the more developed and more advanced stock markets, we're starting to look a bit expensive. Then growth has consistently outperformed value since the whole great financial crisis. This is just a ratio kind of showing what we talk about quite a bit here. where when this line's going up, this is world value, which had been outperforming as the market was really underperforming. And now that's starting to go back down. And then this is, I think it's an update, but it's pretty close to a chart that I've been showing in the weekly videos. That real rates, when they're greater than 2.5%, this is when some kind of bubble pops. And this is taking inflation into account here. And we are coming up to this. We were at this level and then coming down from there. If interest rates really start to go up, at some point that may continue to cause a problem. But this may be one of those short-term things that the market kind of freaks out about. Interest rates get under control. They start to come back down. The market still looks positive and tends to reflect more on the positive side of things. And then this is when payrolls are over 225,000, there's a no landing, meaning that we don't go into a recession. We don't really see a real economic slowdown because employment has stayed pretty strong. When we have 175,000 to 200,000, that's a soft landing. If we're under 100,000, that's a hard landing. And this is just taking the payroll that we received a week ago and then looking at the ISM manufacturing and how it's still under 50. So it's showing contraction, but it has been starting to go back up. And then this is the decline of the euro against the dollar, where this is other times when we're basically looking at the change here. And the dollar has been showing a bit of a bounce here. It could be hitting some overhead resistance as it comes to the upper end of this trend line. Didn't really find anything interesting on Twitter. I didn't spend an awful lot of time there. I kind of binge. I watch it for a while and look at things, and then I might go a while and not do that. Here's our chart where it was quite a choppy day. We did actually have a positive open. We didn't quite get up to R1, but then immediately we saw some selling come down, take us below the daily pivot, below S1, came all the way down to S2, bounced back above S1, and then we chopped our way down again to S2, then went back up to S1. This is like a roller coaster. And then we fell back down below S2, actually came down to around the 51.25 level, and then saw some buying going into the close, and we closed just a little bit below S1. Here's our intraday chart. We were pretty quiet in the initial overnight session, and then Europe opened, and we were looking positive. The market may have been front-running this economic report a little bit, especially the PPI, and kind of assuming, oh, we're going to have an up day, so let's go ahead and go long even before the market even opens. Well, then the reports came out, and we saw the futures and the SPY coming down. And then here's the cash session with all of its choppiness, and we're actually trailing off a little bit in the initial overnight session. This is one thing that was positive. As we were bouncing around, growth held up a lot better than value. And now we see the blue line above the red line when we look at our 10-minute intraday chart. So that is somewhat encouraging. This is also encouraging. We had a down day, and value just really got hit pretty hard. And so this ratio is still going up, and that's showing some underlying strength. Even though we're seeing some weakness, we're not necessarily seeing weakness in this right now. Then our end of day charts, that is blank here, okay? Where growth ended up being up, where value was down, actually a lot more on a percentage basis. Growth was down for the mid caps, but less. And it was also down less for the small caps. And then just to remind folks that are kind of new here, the middle area, why I don't talk about this, these are the corresponding ETFs. And then we break it down into value on the left and growth on the right. So we did come down with our growth to value ratio for the small caps, and you can see they just fell off here. They've been chopping more or less sideways. There's been some optimism, hoping that maybe small caps were getting into gear. And then we have a day like we had on Thursday, and they really were down the most. But we're still holding up as far as the growth to value ratio down here. Yeah, we're declining. Yeah, we're chopping sideways, but we're hanging on to a lot of the breakout that we did see recently. And the growth to value ratio for the mid caps, it ticked up just barely. It's also looking stronger with a more solid uptrend. It also got hit pretty hard on Thursday. And we ticked up with the S&P growth to value ratio. We're not really breaking out, but we're still maintaining a positive trend. And we were up a little bit here, flat to up when we look at the discretionary to staples ratio. We want to see it doing better than what it's been doing. Both got hit, discretionary and staples, on Thursday, but discretionary got hit a little bit less. Here's our trend. The ADX is still just right on top of its moving average. We are following the green line, which is on top, and it's continuing to come down after being above 40, and the red line is starting to come up. But we're still in a positive trend for now. We're also pretty much on top of the moving average with our short-term ADX. The green line is coming down after being above 40. And we did see a bit of a turn up in volume. This was another thing, a down day with an increase in volume. Here's sentiment, and I forgot to post this a few days ago. This is a reading that came out on March 12th, the latest Investors Intelligence Survey. And this is about a week old now. And this tries to measure what people that do newsletters and make recommendations, if they're mostly bullish, then we get a very high reading. And yeah, it's a pretty high reading now, to the point where we might be able to use this as a contrarian indicator. When we look at the VIX, based on the line chart, we did go up with the down day. We also went up with the bar chart, but we closed off of the high. Looking at the volatility of the VIX, with the down day, we saw an increase in volatility with the bar chart and the line chart. And the MACD showing the direction is because the VIX had been going up more on a momentum basis. Then it started to look to be going down. Then it was going back up. Now it's right back down to its moving average. The equity put call ratio, the daily chart did go up with the down day, so there was some additional hedging, and it's probably hard to see, but we're starting to turn back up with the 5-period equity put call ratio. That is more negative when it is going up. We had the latest reading of the American Association of Individual Investors. This was a little surprising because a week ago we were looking more positive, and you would think that they would have had a higher reading up above this extreme level right here, but they actually pulled back slightly. So they're still positive, but not necessarily extreme positive. And here's a newer chart that I've been trying to include about a volatility risk premium. This tends to, well, it's matched up with the VIX very carefully. And when we get a very high reading, that's when stocks are going down. So you read it like you read the VIX. We were getting quite low readings here, showing that there was not a lot of risk premium. And now we're starting to come back up into this range as we had the down day. Advanced decline line studies. We did decline based on price and volume, but these are areas that have been holding up better as of late. And we saw a contraction of the new highs, no real expansion to new lows. We're flatlining with the 5-period, and we're still declining with the 10-period. And we did see a drop off in the advanced decline ratio, where we had been seeing more of a healthy build of higher lows here. And if we turn and go back up, you could still make that case, but we're still looking positive when we just look at this value here. And we were flat with accumulation distribution. On a down day, for this to not really decline, that could be taken as positive. We did decline with the Chaikin money flow, and the moving average is starting to go down, even though it's still positive. And we turned over a little bit here with the Chaikin oscillator, but we're still above zero. So looking at our advanced decline line, we declined with the common stock for the NYSE, the S&P, the mid caps, and the small caps. Really, they came right back down to their moving average. They saw a lot more weakness. Here's our daily chart, where it's kind of hard to really, we're kind of getting into a mess of things up here, but we have not been able to recapture this upward sloping trend line. I have another breakout chart where I added an additional trend line that we seem to be creating. On the bottom, this is one of the few days that we've seen lately with volume being above average. We will be keeping an eye on the 20-period exponential and simple moving averages. That's the blue line and the red line here. If we fall further, we'll be watching to see if this offers support. We are no longer extreme with our 20, 50, and 200-period exponential moving averages. And these are measured just on the price of the S&P 500 itself. So we're turning down in all three areas. We saw a bit of a decline, but we're still positive with the force index. And we're no longer extreme positive in the short term. We're still extreme in the intermediate short term and the long short term. And as I like to explain, this is a further subdivision of the short term time frame. We're not extreme. We're just a little bit into the +2 channel when we look at our standard deviations chart. So nothing really extreme there. Intermediate term, we're right at zero with the balance of power. So it's producing an equilibrium reading right now. And we are still seeing the lighter shade of blue with the go, no-go system. It's more positive when we see the darker blue. We're still above the midpoint with the highest high value. That's positive. And we're turning darker blue now with the TTM squeeze. That's still positive, but with more of a negative slant. We will be watching this little mini rainbow here. This is the 20-period simple moving average of the open, high, low, close to see if one of these lines ends up providing some support if we see more weakness. The ease of movement did decline, but it's still above zero. The Arun declined just a little bit, where the buyers are starting to come down, and we actually saw a bit of a decrease here with the sellers. And we dropped below zero with the McClellan oscillator. So not only do we have this longer-term negative divergence that seems to not be going away now, we're dropping below zero, which is going to turn our summation index negative. So we're just starting to roll over based on price and volume with the summation index for the S&P. We also dropped below zero with the NYSE McClellan oscillator. So we also have this longer negative divergence and also dropping below zero, just beginning to roll over with the summation index based on price and a little bit rolling over, but really hard to see based on volume. We turned down with the Swenlin trading oscillator based on price and volume, but we're still above zero. And our oscillators just haven't been helpful. But if you notice here, based on price, starting to roll over, but we haven't crossed over. Also, we're rolling over but haven't crossed yet based on volume. We saw a decrease with the PMOs that are rising. We're turning down with the buy signals. We're still extreme positive here with the PMOs that are above zero, but now this is starting to roll over. And we've gone from being positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. This is an indicator that I put a lot of importance on. And if we have another down day, especially a significant down day, we'll be seeing if the dots are going to switch over and go on top. Until they do, we can still, in the more intermediate term, have more of a positive stance. The slope oscillator is declining, but still giving us an extreme reading. Also looking at longer-term negative divergences. Seeing it go just a little bit below the moving average with the MACD. Also longer-term negative divergences there. So not getting a lot of help still, but looking a little more negative now when we look at the different oscillators in the short, intermediate, and long term. We will be watching these levels on the moving average tree if we see more weakness. We came down a little bit with the bullish percent index. We're above 70. If we drop below 70, that's when we get a sell signal. We ticked down a little bit with the NYSE bullish percent index, but it actually held up a little bit better. So it's still more positive. And we're seeing more of a decline in the NASDAQ 100 bullish percent index. This was the real market leader. This is what took stocks a lot higher. Now we're starting to see some more weakness in the NASDAQ 100. And is that a concern? Are we going to see a bounce somewhere along the way that can help turn things around and kind of take care of this weakness that we see? The money flow is going back down, but it's still above 50. The ultimate oscillator, for some reason, actually went up. And we are declining with the vortex after setting a series of lower highs here, but we're still positive. And we're still positive with our RSI 14 and 9. Most of the most recent readings have been above 50. We did come down with on-balance volume, but we're still above the advancing moving average. And the stocks above their 20-period moving averages, we were looking a lot better here, possibly enough to negate this negative divergence, maybe not enough to set the previous high, but this really came down as we saw some weakness developing. We actually ticked up a little bit with the 50-period moving average, but we're still seeing this longer-term negative divergence. This is the one that we kind of want to keep an eye on right now. If this can show some improvement, that would show more strength in the market. We are coming down, but getting an extreme reading with our 100-period moving average study. But that doesn't necessarily mean that we're going to turn and go the other way. That just means that there's been good, solid momentum in the longer intermediate term. That's usually what the 100-period measures. And we're coming back down with our 200-period moving average study after being pretty extreme. Again, if we can go up here and stay up here for a while, that it doesn't necessarily mean we're going to go in the opposite direction. But the fact that this did come down is negative. The copy curve dropping a little bit below its moving average now. The Sean trend meter is declining, but still rather extreme. I just wanted to show this because it's just a continuation of a story where the transports continue to really underperform the S&P 500. We've gone more to a doji look here where we have an open and a close pretty much right at the same level with the Heiken Ashi chart. We're still positive with the Kagi chart, but now we're pointing down. The Renko just is partying along like nothing happened. and the 3-line break chart is still positive. And then here's where I added another trend line. This red line, this is the one that we've really been following, and we've kind of dropped below that and have been below it for a few days. So I drew another trend line going to some of these other lows that we've hit here right now, and I put it in blue. Right now, we're still just barely above this blue trend line. So this was showing a lot more strength. Now that we've had to drop back a little bit, that shows that, yeah, we're still positive, but not quite as strong. If we close down below this, again, not far below these trend lines is going to be the 20-day moving averages. And we will be starting a new cycle on March 18th. That's more for informational purposes. Here's the weekly chart, and this is positive longer term. We're still above this 51.10, 51.11 level, this R1 level that we set here. We're still, what, 40 points away from that. So less than 1% move, but still, if we end up closing down below this, especially on a Friday, that's going to make this weekly chart look even more negative. If we can stay above that, that would keep things looking a little more positive. We are still extreme, but coming down with our 150 and 200 period simple moving averages. We switched over to negative in the short term, according to the Keller market model, but all of the other indexes and timeframes are still positive. And we started off good with the up day that we saw, or the up open. It was produced an awful lot of blue or green, right, to start things off, but then everything kind of turned red after that. The equal weight index did decline with the S&P weighted index, and the mega caps held up a little bit better, so the S&P slightly outperformed the equal weight S&P. The Dow is kind of just chopping more or less sideways. It was down 1/3% and still above this pivot point here. We still remain positive when we look at the diamonds for the Elder's Impulse system, and we're right in between these two areas that I've been watching with the NASDAQ. We have R1 above current price, which may act as resistance. We have this pivot point, which is below. We're just kind of chopping around right in between, and we're seeing pretty much that same thing with the NASDAQ 100. This R1 level to the upside and the pivot level to the downside. We have changed over to negative with the QQQs with the Elder's Impulse system, and our momentum for the NASDAQ 100 continues to be negative and is trailing off a bit here. Here we're following the 20-period moving average for the QQQs. We did get down below it, but we were able to close above that. So far, this moving average has held. And we're watching this longer-term NASDAQ 100 to Dow ratio. We're right about on this upper extreme reading that we had in the past, and it's going to take a little bit of time for this to play out. We just want to keep an eye on this for now. The small caps were down, was that 1.6% and dropped below the pivot point based on the S&P index and closed below the 50-period moving average. We've changed over to negative with the Elder's Impulse system for the small caps. We're going down below 50 with the RSI when we look at the Russell 2000 small caps. We're still above the 50-period moving average, but the momentum is now crossing over negative. However, the longer-term trend still continues to be positive. The mid-caps also got hit pretty hard, fell down below this R1 level, but they still remain neutral with the mid-caps when looking at the Elder's Impulse system. And Google doing pretty good. It was up 2.37%, and it's been able to clear its 50-day moving average. So this is showing a little bit of hope when we look at some of the Magnificent Seven stocks that have been having a little problem lately, like Apple. It was up over 1%, but still generating a death cross here when we look at the 50 period compared to the 200 period moving averages. Tesla ended up being down. It's just really having some problems these days, and it's just not a very good looking chart in the short term. The FANG index is still pretty much chopping sideways and still in a longer term uptrend. The financial sector was down, but still is in an uptrend. Just keeping an eye on New York Community Bank. It was unchanged. Haven't seen that in quite a while here. The dollar is bouncing back up a little bit, and we can see these moving averages. If we get back above this, we might see a golden cross with the trend. Here's another new chart. This is a request, and I don't know if this is the exact chart that was asked for here. The Morgan Stanley, they put out a number of world indexes, but the frustrating part is they'll say, okay, here's the world index except for Canada, or here's the world index except for, I don't know, Zimbabwe or something like that. Well, they also have one excluding the US, and so I'm just kind of going with this until I get more feedback. and then comparing it to the S&P 500. And then down below, I have the shorter term correlation showing that they're having a pretty strong tendency to go in the same direction. And then 50 period, that means that this is longer term, and they do correlate pretty well, meaning they go in the same direction at the same time. And you can kind of see that when we compare the black line, which is the world index, with the red line, which is the S&P 500. And it's been chopping around a little bit lately, but the longer term moves tend to go more in tandem with each other. Looking at bonds, we really went up with the 10-year yield. We're up at 4.3%. We really fell with the 10-year based on price. And then looking at growth of value, it's showing some weakness here with the QQQs to the S&P, discretionary to the S&P, large cap growth compared to large cap value, not really showing any real weakness, but it's still below a declining moving average. So with the large caps, we're just about at the moving average. We're at the moving average with the mid caps, and we've come down to the moving average with the small caps. And it was the mid caps and small caps that were showing a little bit more strength. That was pretty much taken out on Thursday. We're still positive longer term with our 5-period moving average of the highs minus the lows across the broad market. And we're still extreme positive here with our 10-day average of the S&P 500 highs minus the lows. So what's our outlook for Friday? It will be quadruple witching. That's options expiration. It's kind of its own beast as far as a day is concerned. Usually we see a real pickup in volume, and it becomes about strike prices and in the money and out of the money options that it can produce some really wild swings, but then other times it's like, what? It was options expiration? I didn't realize that happened. The technicals are still positive right now. We are seeing some signs of weakness. Now, we haven't switched over negative yet. We're just seeing some things. So right now, it is looking more like a pullback. Can the market get its feet together? Can interest rates start to come back down and possibly give some more support to stocks? We're still above that overhead resistance, that longer term weekly chart, and we possibly are coming into a time of weak seasonality. We're going to get import and export prices, not a real huge impactor. We get industrial production and capacity utilization. I know a lot of folks think this isn't that big of a deal. Maybe it goes back to my Alan Greenspan days. He really paid attention to this. And so when he was the chairperson of the Fed, I really watched this because I know he was really watching it. And then consumer sentiment can have an impact on the market. Keeping an eye on all the craziness going on in the world right now, but the market isn't really paying all that much attention. Here's the completed economic calendar for the week. Seasonality, we're positive with the Dow, and we're neutral to positive with the S&P and NASDAQ. We do tend to be up 66% of the time for options expiration week. We're down 34% of the time. We do see a little bit of negative seasonality here with the green dashed line coming down a bit for the 11th trading day of the month. And then we could go into a period of some weak seasonality that just doesn't seem to have really developed with any conviction, at least yet. This is also suggesting that we should be open to the idea of seeing some weak seasonality. Friday is the second best positive day of the month, going back to how things behaved in 2023. And Tom Bowley still has us in this positive area for the month of March. So our warning signs, we did see an increase in volume on a down day. That's kind of a change of what we've been seeing lately. The Copic curve is turning negative. We have our whole list of negative divergences. And I showed you the chart of the transports to the Dow and S&P. And the small caps got hit pretty hard there as well. And we could be entering a time of historical seasonal weakness. Positive signs. Actually, this should have been switched back over to the other slide. This should be on the other one, and it's starting to go back up. The parabolic SAR for right now is positive. The vortex is positive, but still it's showing some more weakness. Small and mid cap growth is positive. The large caps for the growth area that we're looking at for the S&P, that's holding up for right now. And the financial sector is positive. So our conclusion, we are positive. We are seeing some signs of weakness, but the market could take care of that with a good solid up day. If we see more weakness, we're going to see even more deterioration in our charts, but it's still looking like a pullback as of right now. We're still above that longer term overhead resistance, and we possibly could come into a period of weak seasonality. That's what we're watching in the short term. Intermediate term, we still have kind of a list of overbought indicators right now. It's that overhead resistance, especially with coming into a Friday, and it'll be printing out on the weekly chart. If we can close above that line, it would make that chart look better. If we close below that, it'll take one of those lines away that's making it look more positive. And we're still positive in the long term, but we have those longer term moving averages that are still extreme positive. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.